Guys, welcome back to a new video. Today we're going to take a look at the dollar index as a whole, because understanding how the dollar is doing will give us a clear indication of how we can trade that against any other currency pair. And the reason why we're also going to speak about the dollar index, because why? We know that the Federal Reserve has had a nice meeting yesterday, and we're going to cover exactly what the key takeaways is from that and how this is going to affect the stock markets as well. Now, if you're new to the channel, a sub would be appreciated, as I provide valuable educational content on a daily basis. And as always, if you enjoy the video, please smash that like button for the YouTube algorithm. And as always, let me know down in the comments below exactly what it is that you would like for me to cover in my next video. Now, we're going to start with the dollar index from a technical perspective. Firstly, starting here on the monthly time frame, what do we have? Firstly, we can see how the market printed this overextended information, came back to retest the left leg. Definitely a continuation expected to the upside as well. Now we can also see that the market had printed this most recent structure, which acted as a level of resistance over there, and market broke below that, and it's currently testing it as support. However, one thing to keep in mind is that if you look slightly left, we can also see how the market had been stuck within this consolidation. The market entered this consolidation phase in December, and the market had just been moving in between those two key points, and we can definitely expect a breakout in the near future, with the interest rate hikes looming closer and closer, and asset purchases being reduced as well. Now on the weekly time frame, what do we have? Now on the weekly time frame, we can see how the market printed this massive impulse. We got the correction, and we got the pullback to the minus 27 as expected. Now we can also see how the market printed this very important structure. Now this level over here acted as a level of support, but got broken, but got tested as resistance. The market then broke above that, and is now testing it once again as support, giving us an indication that even though we are in a consolidation market, there's definitely a continuation expected to the upside as well. Now from a daily perspective, what do we have? Now here on the daily time frame, we can see how the market printed this massive impulse, and if you want to measure that correction, just take your Fibonacci from the low to the high over there, and you can see how the market had pulled back almost to the 61.8, but we got a the rejection from the 0.50, which gives us an indication that it was a 50% retracement of this massive impulse there as well. Now, one thing to keep in mind, if we do get a candle that's going to close with this massive wick, then we can definitely expect the next candle to go and fill in that wick there as well. Now, that is what we have from a technical standpoint. Now next we're going to look at some order flow data, so the commitment of traders. Now this tells us what the big banks and hedge funds are doing in the market. We can see a base of last week's report, how they came in, and they closed minus 3,527 of their long positions, which is buy positions, and they also closed minus 2,721 selling positions, and the overall net position slightly decreased from 34,571 to 33,765 over there. And we can clearly see last week we had some bullish and bearish momentum, but once again, because we are stuck in a consolidation, that's normally something that you'll see from an order flow perspective. Now if we go and look at the fundamental data, so what what's actually happening in the markets, and we can see here, first of all, it says here, based off the meeting that they had yesterday, minutes, so Federal Reserve is ready to raise interest rates and to shrink the balance sheet soon. Now if there's one thing I want you to take away from this, is two things, is that you shouldn't always go with what the with what people speculate, what they think is going to happen. And to give you an indication of this, was a article from Bloomberg that says here, Federal Reserve doesn't yet favor for a half-point hike or an emergency move. That says here, inflation reports showed fastest pace gains in 4 decades. Now we've been speaking about the inflation of the US for many times. It also says here traders saw an even chance of a 50% basis point move after the data. Now This data obviously came out before the Federal Reserve meeting, because you can see here this was on February the 11th. Now, if you follow this information that you received here, and then we just got the latest information that came out yesterday as well, and you'll see that the data reads otherwise as well. So I'm going to close that. Next, we've got Goldman Sachs saying that they predict the Federal Reserve to hike the interest rate 7 times. I mean, come on, 7 times? I think that's 100% ridiculous, because I mean, why would they go and raise it seven times for? They could just do it once, well, not once, but a couple of times at a 50 basis points, and but you know, but the bottom of the line is the interest rate hikes is coming. Now, if you go and look at this data that we received yesterday over here, it says the Federal Reserve officials outlined plan for interest rate hikes and a reduction in the asset holdings on their balance sheets at the last meeting. The minutes released on Wednesday, which was yesterday from January session, show concern about inflation and financial stability, though members urged a measured approach to tightening monetary policies. Now, basically what that means is that although they although inflation is sky high in the US, the Federal Reserve still want to approach the interest rate hikes and not come in guns blazing. So, although you've got people like JP Morgan saying that the Federal Reserve could rate hike interest rates 7 or 8 times, they came out yesterday and they said, you know what, we are gonna hike the interest rates, but we want to do it in a steadily move. Like, we want to recover the economy in a steadily move there as well. It also says here that FOMC members noted that inflation was beginning to spread beyond pandemic affected sectors and into broader economy as well. Now, if you remember what inflation was like back in 2020 when the coronavirus, when people started losing their jobs and all of that stuff, that just shows now, because because Powell back then, he printed it all that money, did a lot of asset purchases to to raise the economy to where it is today. However, inflation is now a lot worse than what it was back in 2020. So, we're stuck between whether the Fed is going to hike the rates aggressively, or whether they're going to do it on a steadily increase there as well. Here's a um, it says here the policy making Federal Open Market Committee decided after 2 day session that it would not raise interest rate yet, but strongly indicated a hike on its way soon as March. So once again, we knew that this was going to happen only in March, and then you'll get people coming out of nowhere saying that the Federal Reserve could do a emergency interest rate hike, and so you got all of this stuff. People are just confusing us with the information, and now we know that we can expect the Federal Reserve to come out and hike the interest rates as well. It also says here a couple of the participants stated that they favored ending the committee's net asset purchases sooner, to send an even stronger signal that the committee was committed to bringing down inflation. The minute said that basically what that means is that you have a lot of rich people sitting around the table, and they decide that, about the interest rate hike, which basis points they're going to hike it from, and they are just they just doing what normal people, what people in that position would do, is they just trying to convince the market that they shouldn't stress, they shouldn't worry, because they've got everything under control. And that's why they say to send an even stronger signal to the committee that they were committed to bring the inflation down. That's it. It doesn't matter how you look at that as well. Now, if there's one thing that we need to keep in mind, is how this affects the stock market in general, because we know that the stock markets are overvalued, especially the S&P 500, as well as the Nasdaq and the Dow Jones as well. Now, if we go and look at this chart over here, it's called the S&P PE ratio, and this shows us exactly what the market valuation was at the start of every interest rate hike. Now you can see in 1983 it was sitting at 12.7%, but I'm not going to go through all of these numbers. I want you to focus on the blue ones. Now you can see that the only time it was higher than what it is now was in 1999. And if you don't remember what happened in 1999, let me give you an indication over here. So in 1999 to 2000, we had the dot-com bubble, where it was the biggest crash in the history of stock markets as well. Now, that basically gives us an indication that we can definitely expect the stock market sell-off to actually happen as soon as they start hiking interest rates aggressively in the month of March. Because why? Interest rates, I've said this many times, interest rates directly negatively impact the stock market due to devalued in terms of their evaluation. Consumers are spending less money, and these companies accumulate revenue through consumer spendings as well. If you look at the consumer debt versus the valuation of these companies, you'll understand why they are growing, because they grow with debt. But if people are not making any debt, they're not making any money. That says here the Bank of America clients haven't been this bearish on tech stocks since 2006. It says here fund managers haven't been this bearish on technology stocks in almost 16 years as they brace for aggressive Federal Reserve policy tightening. The latest Bank of America Corporation survey shows that net allocations to the tech sector fell to the lowest since 2006 in August, according to the poll conducted from February there as well. Now, that is enough information to make anybody go, okay, so what does that mean? Well, ladies and gentlemen, it means two things. Firstly, when the Federal Reserve hikes interest rates, that means that you can expect the dollar to increase in value because investors invest in markets where interest rates are high because the return on the investment will be higher. Interest rates, on the other hand, impact consumers negatively because every piece of debt that they own has got interest attached to it from the lender that they need to pay back, plus the interest rate hikes that come with it. Now, the higher they raise the interest rates, the bigger the punch. Why? Because if they hike interest rates by 0.25 basis points, that means that whatever debt the consumer has, which is already in a 15 trillion problem itself, um, that means that the interest rate will increase by that amount because the interest rate gets passed down to the lender, and the lender then passes that down to the borrower, which needs to pay back that interest. But if the interest rate is slightly higher, if they hike the interest rate by 0.50 basis points, then that means the consumer needs to pay back even more, meaning that there's no time to go to Amazon or to Apple to buy some fancy stuff that you want to, which is all elite, which is all composite stocks listed on the Nasdaq 100. Now, what's even worse that if the Federal Reserve hike interest rates more than 2 or 3 times, it just means that the interest paid on a home loan or a car loan will increase and increase and increase. And if you look at wage increase versus inflation, you'll understand why an interest rate hike is not good for the consumer, but it's good for the economy, and it helps tackle inflation, and it helps people spend less money out there. But consumers at the end of the day will still be nailed to the ground because why? The more they hike the interest rate, the higher their per month payment will go, and their salary is not capable of keeping up with that, which is probably going to send the US economy into a recession as well. Now, ladies and gentlemen, next month, before the reserve, before the Federal Reserve interest rate decision, you can expect it to increase. It has to increase. It must increase. There is no other option for the Federal Reserve next month. And you can expect this massive sell-off on stock markets, um, probably the same way we saw it back in 2000 and sorry in 1999, and you can expect that sell-off to come, but that sell-off is slowly coming through. If you've seen the Nasdaq, slightly last month, mess of bearish candle. This month also quite bearish, still stuck within a consolidation phase, but the sell-off is coming whether you like it or not. It's coming, and that's it. You have been given some good advice here, so make sure that you made that informative decision. Now, that's all from my side, and as always, cheers for ears.